We are delighted to have Danielle DiMartino Booth, founder and CIO of QI Research, again with us today to talk about the big employment report, as well as other employment indicators that we found, and as well as the outlook for the economy, because I think we're in an inflection point, particularly with the term premium and the bond markets, and we're going to love to have your input on this. So let's start with the employment report today. The market certainly seems to have liked it, but there seems to be, some warning signs. Would you go into that for us?
So, it's interesting because our mantra at QI Research, which was not always the case, has become trade the narrative, own the truth. And how markets trade has become so divorced from the actual data once you get into it, which helps explain why we have this aberrant behavior where the bond market is kind of falling out of bed and the stock market is going up. Normally, you would not see these two markets moving against one another. In other words, normally if you see bond yields falling, well, the stock market likes that. But today we've got bond yields rising because there's less of a chance of the Federal Reserve moving sooner in 2025 than what had been baked in earlier this week, when all of the other data is saying, whoa, we're in recession, from ISM services to initial jobless claims popping up above their cycle, their recent high, to continuing jobless claims being stubbornly above the 1.9 million level, to we're going to talk about the quarterly census of employment and wages and what that said about the end of 2024. Nothing in the data suggests that the Fed should be on hold right now. And yet, what the market knows and what the market is trading off of is the fact that Jay Powell is going to stick to the rosier than expected headline view. And that's all he's going to make monetary policy based on. And the market has gotten wise to this.
It's interesting that one of the things that I saw, that labor force participation fell a couple of tenths, and I'm not sure what's driving that. Is it lower immigration so far this year? But that certainly helped the unemployment rate stay low, is my guess.
It did. In fact, that 0.2% decrease in the labor force participation rate to where it was in, I think, November 2021. So we've seen a big step back there. Had that not decreased, we would have instead seen a 0.2% move upwards in the unemployment rate. And even as things stand at 4.24% out to 3 decimals, we did actually have the highest print in the post-pandemic era, even as tame as 4.2% sounds for the U3 headline. When you go out to that 3rd decimal point, it did mark the high.
Right. I wanted to touch on what you put in the Daily Feather, you and your team put on the Daily Feather today. It was great, using Elliott Wave to look at jobless claims. And you could see how, it's really an interesting take on it. And, now we've had 2 weeks above 240, and, it's not like a 1 week spike anymore. Do you have a sense, based on what you've seen, what the top of this cycle in jobless claims might be, and, when we might see that, roughly?
So I think more important than peak in jobless claims is how the market perceives jobless claims. Once we cross that 300,000 a week threshold, and it looks like we're getting closer and closer to that, that's kind of when the market throws in the towel and says, okay, it doesn't matter what anybody's saying. It doesn't matter what my opinion is. It doesn't matter what Jay Powell's opinion is. We're in recession. And that is, we call them stock jocks. That is how stock jocks operate. They're looking for numerical thresholds. And once we cross that 300,000, which, by the way, of the wave of jobless claims would break free of the range that we've seen in this pandemic cycle, then the market's going to look at that as being the signpost, the threshold.
Interesting. And certainly I think, people like one number they can stick on instead of doing all the hard analysis, which is what you guys do.
At QI, we try our very best to look forward and try to tell investors where the economy is right now so that they can focus on driving through the front windshield instead of what the Federal Reserve does. And we've also got the highest number of part-time for economic reasons that we've had in the current cycle. I bring this up because to the extent that you're seeing increases in self-employed and part-time for economic reasons, aggregate income is coming down because people are taking work that they don't want. They would prefer full-time work and full-time wages and a full-time paycheck that goes with it. And when you see, especially again, at economic inflection points, when you see big rises in self-employed, that's somebody going on LinkedIn who's lost their job and creating an LLC of their initials so that they can have it appear, if a potential employer is looking at them, that they did not have a stoppage in their work. But that really is what self-employed. It's not that there's some entrepreneurial surge in the United States. Certainly not when financing is so hard to come by to start a new business.
Right.
So we look at these as red flags, self-employed and part-time for economic reasons, because those are people who would rather have full-time jobs.
I want to move a little bit off to a different topic that the market's been talking a lot about, and it's sort of the rise of the term premium. That the paradigm that we saw that when there's bad news, you just buy U.S. bonds, and we're not seeing that in part due to, I guess, the president trying to make the U.S. a less friendly place to invest by weakening the dollar and doing other things, but. This term premium is now, it seems like the paradigm is changing, that, the United States might have to pay to borrow longer term. Are you seeing indications of that?
I would humbly venture that the record high position in shorts against the US 10-year Treasury bond in the third week of May and the current record short position in the 5-year Treasury, that has a lot more to do with what you're seeing. We're talking about the largest hedge funds in existence who are positioned to profit if Treasury yields rise, if Treasury prices decline. And this is a situation of don't fight the market.
Right.
Because that's what we have here. And whenever you're a player in the market, as I'm sure you've been around long enough to know, Tai, what you do is you talk your book.
Right. Right.
And if pumping up this narrative is going to help you profit more, you're going to pump up the narrative. You're going to go on Bubble Vision and do your very best to gather followers and make the trade even bigger so that you can profit even more. If I wasn't seeing the record short positions in treasuries, then I would give more credence to the idea of foreign investors backing away. We actually haven't seen that coming out of China. What we have seen foreigners do, however, is sell the daylights out of the dollar.
Right. Right.
And that is really where we're seeing that manifestation. And recall, the FX markets are the largest in the world, $7 trillion a day in trading volume. What's happening in the dollar right now is much more consequential, in my view, than what's happening with the bond market.
I think we're going to have you on again in after the next Fed meeting. But yes. Between now and then, what are a couple of things that you're really watching closely?
We're continuing to see very large bankruptcies. So that is kind of what distinguishes 2025 from 2024. It's not that we're seeing more in terms of the number of bankruptcies, but they're bigger. So that's going to have a greater ripple effect in the economy. And we're starting to see companies that we would not normally see announce layoffs doing so, like General Mills, like Procter & Gamble. And those are considered to be much more defensive plays, your consumer staples. If goods inflation is ticking up some and wage growth is not keeping up in the aggregate, self-employed, part-time for economic reasons, that means that something else is going to have to give. And what's giving is people spending money on vacations, other services type of spending, because they're simply, they have to balance out against rising goods prices to the extent that tariffs are affecting them by spending less on services. So these are the things I'm watching the most closely.
Awesome. Thank you so much for joining us today. Looking forward to having you dissect, the next Fed press conference and Fed meeting in a couple of weeks. Thank you so much.
Looking forward to it so much myself. Thank you.